him, except that he's he's one of our clients, but I think not the most important client that we have, I have to say. And this is also not the most profitable client. This is the reason why he's here. But I thought this is probably the more interesting client that we recently met, and I'm looking forward listening to one thing which might be important or should be important for everyone. He just told me this, what I'm going to tell you today is important for everybody having a bank account. So I suppose that everybody should be interested, especially people having 2 or 3 or even more bank accounts. The floor is yours.
Hopefully they're all declared at year end. Okay, so just a little bit quickly about my background. I was born in Tel Aviv in Israel, where I got my bachelor. Then I moved to Chicago to do a PhD program. A PhD program takes 5 years to complete, and you don't have to have a master's before to get admitted in the United States. So the University of Chicago Booth School of Business, it's a hard place. I've seen lots of hardworking people all over the world, but nothing compares to the work ethic of the people at the University of Chicago Booth School of Business and Department of Economics. I had 2 professors of mine. They won the Nobel Prize a quarter before my defense. So I was there when it happened, and they are not easy people. They're grumpy. They don't really help you. They help you help yourself, so to speak. And it was good. Then I was working at UBS, okay, for almost 3 years. I had a unique position, I'd say. I don't know anyone else that had a position even similar to mine. I was an analyst to one guy. He's the chairman of the board. Okay, I met him while I was at the University of Chicago. He was a visiting professor. And he just told me when he was starting his job, why don't you come with me and help me figure things out, and we'll figure it out together what's going to be afterwards later. And it was kind of like that. So this, my experience draws a lot on what I saw in the bank, because I had quite a unique view to everything that goes on in the bank. Okay, so you guys know a bank is a pyramid, where people say yes sir, no sir to the one above them. And at the top you have the CEO and his group of executive management, and they all reporting to the board of directors. The board of directors is like a round table of elderly wise men, and they are there to say okay or maybe not okay and ask a few questions, but this is their challenge to contribute to the discussion when things are already pre-made for them to say okay. And this is where I was contributing to kind of read the entire material of the business activities and the financials of the bank, the audit committee, the risk committee, and the compensation committee of the board of directors of the group. I was reviewing those, and we would sit down every 5 or 6 weeks before the board meetings. When I left, I started this hedge fund, which is what I do today. I always wanted to just manage my own capital, and this is what I'm doing. It started as my personal portfolio, which I just kind of incorporated into a hedge fund. I got the license, I got the auditor, I got the tax consultant and the tax reporting, and I'm good to go now to onboard clients, and they're coming. And this is really the last piece of my experience that brought everything together, together with me teaching, by the way, at the University of Zurich. So preparing the course for the students to try to teach them from the beginning what is money, which is what I'm going to teach you today. Everything came down together to bring quite a holistic. So people in this profession, they sometimes think, oh, I just do auditing, or I just do reporting, or I'm a private banker, or I'm just an investment banker. Private banker would say, oh, I don't know what investment bankers do, I just do private banking. Investment banker would say, well, I know everything. That's just the type of people, okay? You have different types of people. Okay, let's start with what is money, because I'm going to skip real quick with these arcane things. We're going to get to the business real quick, but still starting slow, because I think that after the education, the background that I've went, I can say with confidence that there is a very critical lesson missing in everyone's financial and economic education, which is how the basic accounting facts of money, without theory, of blah, 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 blah in the macroeconomy. Firstly, the basic accounting mechanics and facts of what is money, okay? And this I want to talk about today. And everywhere I go, I want to talk about this because I think it's extremely important and it has quite meaningful implications that people don't fully understand as regards the monopoly power that banks have to date, and increasingly so. Okay, ancient money used to be commodities which had some value in and by themselves. Gold, silver, large stones, alcohol, cigarettes, cannabis. I don't know if you like jail documentaries, I do. Calories, these things, actually, where I come from in Tel Aviv Beach, you can walk on the beach and try to look for these, and these are actually the hardest to find. They're the most beautiful of all the shells that you can find on the beach, and you find them with quite a predictable frequency. Okay, so it's no wonder that they, of all other shells, kind of evolved to be money. They served as money up to as recently as 200 years ago in West Africa. Okay, gold has been money for a long time. There's around 140,000 metric tons valued at around $7.5 trillion. Okay, and rhinestones, this is an important example for when we very shortly get to what is base money, the money that we have in our pockets. So that's an important example from the island of Yap, also called Micronesia. So they had these giant stones, and these served as money. And this is like the junkyard of stones. And the point is that you didn't really have to move these things. And also people today, they think, oh, I'm sending you money. They imagine the money moving from my account and traveling and reaching your account. But money doesn't move. Okay, money is not a concrete object. It's an accounting ledger entry. Okay, and similarly, the stones didn't really have to move. The ownership of, say, a house was kept not even in a written history of ownership, but just with an oral history of ownership. So let's say I had a piece of land, and I wanted to sell it to you for one of these big stones, so you could, build a house on it. And all we needed is a few witnesses, and then you would get the land and I would get the stone. But the stone would still be in the junkyard. It wouldn't actually move. Okay, so I want you to keep in mind that money doesn't actually have to move. On the other hand, we do see that they put a hole in it and sticks, so they could carry it around if they needed to. Okay, so that's an interesting example. Okay, the problem with commodity money is that the supply is not predetermined. So many resources going down on the beach and finding shells. It's hard to verify how much gold is inside really the coin, and so on. Other comments, money doesn't have to have intrinsic value. Obviously, these papers or ledger entries that we use as money nowadays doesn't have any value in it by themselves. And gold, similarly, doesn't have that much intrinsic value. I mean, the value of gold is this much, but its value, its demand just for jewelry is tiny compared to its value in the market. It's hard to explain why it would have such a huge value unless it was historically serving as a store of value. Okay, but we're not here to yap about stones. Okay? Let's get to fiat currency. Okay, fiat currency is any money declared by a government to be legal tender. It's accepted as payment to settle all debts, public and private. Okay, so I want you to keep this in mind also. The definition of money is what you pay back debt with. it's kind of a circuitous definition. They want you to keep that in mind because all of fiat currency is debt. Okay, and people don't understand that. People have heard that maybe on Facebook videos on how they're printing and the debt is, and scary videos, but you don't really learn anything from these videos. I'm going to show you what it really means. That money is debt, by definition, by accounting fact. Okay, and that's really important to understand the accounting facts. You know what you can do with money, anything you can do with money. Why is everything denominated in money? You buy services, you buy goods, you buy a house, securities you buy with money, you get dividends in cash, you can get dividend in kind too. Okay? Lending money is done with money, right? Money in, money out. Why is this the case? The law said so in the beginning, and that's how it came to be. The law continues to say so that certain transactions can only be settled in a given currency, but it's not necessary anymore because now it's a stable equilibrium. I mean, I'm not going to carry Japanese yen in my pockets and try to buy coffee here because nobody else is going to accept that. Okay, base money. M0 is base money. It's the amount of money actually issued by the central bank. Okay? The definition is the banknotes in circulation, what you have in your pockets, plus the sight deposits of the banks and the government with the central bank. Okay? And sight deposits are funds which can be immediately and without restriction transferred to another account. Okay? So this is how the central bank balance sheet looks like. They have deposits from the commercial banks, UBS, Credit Suisse, okay? And on the asset side is securities, mostly government bonds, okay, in the United States. So this money, the central bank's balance sheet, JPM, when it has an account with the central bank, it's just like you having an account with, say, Credit Suisse. You log into your e-banking, just like JP Morgan would log into their portal with the central bank, and they would see how much balance they have. And they can take that balance, just like you can, and issue a payment to another bank. They cannot issue it to a person, they have to pay it to another bank, because only banks are allowed to have an account, and the Treasury are allowed to have an account with the central bank. Okay, maybe you can start asking yourself, why is this the case? That only they can. Okay, maybe it shouldn't be the case. Think about it. So, this balance sheet of the Federal Reserve, and their balance sheet is really quite a simple one, very, very simple one, a huge one, very simple one, okay? Their liabilities are the notes in circulation, that's 1.3 trillion, and right, plus the sight deposits of the banks. So together it's about 4 trillion. And their equity is next to nothing. Okay? And on the other hand, their assets are comprised about half from US Treasury, government bonds, and another half mortgage-backed securities. Okay? So this is what they decided. From all the universe of things that they could buy, they've decided just to buy these two things. Okay? We're not going to go into the theory of why this is the case, okay?
One dumb question. If you are a bank, what do you need to give to the central bank to have a sight deposit?
You need to, it's called a bank application, bank license application. You need to apply to get a banking license, and if you're approved, you get an account. And you get two things, two very critical privileges. One is you're allowed to have an account with the central bank, And two, you're allowed to take deposits from the public and give them their own accounts. And you need minimum capital requirements, minimum people employed. There's many, many rules. It's not an easy thing. Okay? I also want an account. I'm sensing that you want an account with the central bank. Me too. Me too.
It looks like it's free, almost.
It is free. You just need a banking license, not a big deal. Okay, so they get to have an account directly with the central bank, but we have to go through one of them to have an account. Okay, so look at this. It's a simplified bank. I call it a degenerate bank because let's say JPM, all it was allowed to do with the money that we, client 1, 2, and 3, deposit with it is to take the money and deposit it with the central bank. So it would be kind of a risk-free commercial bank. Because all they did, they wouldn't lend out, they wouldn't try to make a profit on us, maybe just a small fee. They would simply take our deposits and put it there. So the way it looks like this, it doesn't look so, greedy and monopolized. Okay, but you see the monopoly power here. The monopoly, which is money, starts with the central bank, and it's maintained because only very few institutions, for-profit institutions, are allowed to have an account with the central bank and at the same time offer and take deposits from the public. So it starts with a monopoly and goes down to an oligopoly and then goes down to the public. Okay, this is the situation in every country. And just about how this is a database. Okay, this is just an Excel spreadsheet, just like this table, but it is held on a database kept on a server owned by the central bank. Okay, so the information on how much each bank deposited with the central bank is held in a database kept on a server owned by the central bank. Okay, and the authorized employees or software can say, okay, JP Morgan, you don't have 50, now you have 49, and Citibank, you don't have 15, now you have 60. Okay, this is a database that's held with the central bank. And similarly, how much each client deposited with each bank is also kept on a database. And this database is on a server that's owned by JP Morgan. Okay, this is where the money is. Okay, people think the money is traveling and they get scared that if the money didn't reach the destination, maybe the money disappeared and nobody can retrieve it. But this can't really happen. Okay, money cannot really disappear. You can always tell where the money is. Maybe you cannot retrieve it because the person doesn't want to give it back to you, but the money cannot simply disappear, poof, from the system because it's just kept on a database and you can always kind of calculate where the money is. Okay, so a few examples. Maybe you have a few questions now. Well, a few examples are useful at this point. We're not going to do all of them, but base money is the sight deposit never leaves the central bank. Okay, so that's why when people talk about, oh, it's an offshore transfer of dollars, they imagine as if there are dollars somewhere in Zimbabwe or Russia that now they're going to move to another place, and this is good or bad, or the money is not in Russia. There is no dollars in Russia. There are no dollars outside of the Federal Reserve database. Okay, the sight deposit never leave that database. And just like the rhinestones, they never leave the junkyard. Okay? And so let's do a transfer within banks. So let's say client 1 now pays $5 to client 2. So now both of them will have 20 here. And the total amount of deposits that JP Morgan has with the central bank would stay the same. And so will the total amount of sight deposits. What if it's a transfer between banks? then let's say JP Morgan's pay 5 to Citibank. Now Citibank has 20, JP Morgan 45, and the amount of side deposits stays the same. It's just like the amount of rice stones for every given transaction stays the same. Okay, even if it's a foreign exchange transaction. Okay, this is one of the first things that people kind of ask me, hey, but what about a foreign exchange transaction? Okay, so think about two islands, one have, round stones and one have black stones, and they decide to trade between them at a certain exchange rate, maybe 1 for 1 or 1 for 2. And all that means now is in this junkyard on this island, there was a little name of the seller. Now it changes to my name, the buyer, and on my island, the one stone that I sold him had my name next to it, but now has his name. So the amount of stones never change, and even the location of the stones doesn't have to change. Just the name next to it changes. And that's true even if it's a foreign exchange transaction. And a loan between banks, we're going to talk about in a second. Or just a purchase of securities, okay? So let's say now I buy some stocks, Apple shares or whatever. Then I'm going to send my dollars to the seller of those Apple shares. Whether it's an IPO, then Apple, the company, would get it, or if it's on the secondary market, then the seller would get the money. The point is now the money is still there. Only the name next to it changed from me to the seller's name. So now the seller has the money, the total amount of money didn't change, and I have the securities. So when private bankers tell you, oh, clients are sitting on a lot of cash, so stocks can go higher, you can just mute them, because it's by definition incorrect. Because now let's say they all bought with this money securities. Now the sellers of these securities would have this money. Okay, so by definition, this is an empty conversation. What about borrowing and lending between depository institutions? This is important because on the media and everywhere you hear about the interest rate. The central bank is going to change, increase or decrease, or set the interest rate. Which interest rate? The interest rate on a loan between me and you? No. Interest rate on a loan between companies and who? Which interest rate is he talking about? There are many different types of loans out there. Which interest rate is he targeting that he wants to be at such a very precise range? Do you guys know? So the answer is the interest rate on overnight loans between the depository institutions. So it may be that Bank of America needs just a little bit more cash, maybe to satisfy a client's deposit withdrawal request, and they're not insolvent, they can get it, but maybe in a few days, so they just want to borrow it overnight from, say, JP Morgan, who has just plenty, and this would be done at an interest rate. So they would move 50, they would move 1 here, and then this would be 6, and this would be 49, and commensurately there would be a loan note that Bank of America owes $1 to JP Morgan, and there would be an interest rate on that, and this is the interest rate that the central bank is targeting. Okay, when they said the interest rate going to go higher or lower, this is the interest rate that they're talking about. They have many policy tools to cause this interest rate to go higher or lower, but this may be next time, because that's a bit too much for one class. Okay, so far so good? All right. A little bit about the SWIFT transfer protocol. Okay, so sometimes people think that SWIFT is some sort of a clearing house, that people send the money and then they clear it and then you get the money. But that's not correct. SWIFT, like I said, the money never leaves the central bank, but when client 1 of JP Morgan sends a transfer to client 2 of Citibank, they need to adjust their books, both the books of JP Morgan and the book of Citibank and the book of the central bank. Okay? So instructions need to be sent to each of these three institutions to adjust the books, such that the central bank will change the database to say now Citibank has one more that they got from JP Morgan, and JP Morgan has one less on its deposit with the central bank because one of its clients withdrew the money and sent it to another bank. Okay? So just the basic arithmetics of it, they need to be updated on each of these three databases. And the SWIFT is just a messaging system. It's a standardized way. It's like an SMS that they send to each other. So JP Morgan would send it both to the central bank and to Citibank, and it would get updated. It's just instructions on how to update it. And that's what the SWIFT message transfer protocol is. And we can do one quick example about conversion to hard cash. You didn't really ask me how does the hard cash come into our pockets? Okay, so I call these cash deposits, and the notes in circulation I call it hard cash. So let's say Bank A has had no hard cash. It had all of its deposits from clients were kept with the central bank. Okay, so Bank A had 100 deposits from clients. Say there's just 1% in the economy, and these 100 were deposited with the central bank. And now this client wants 10 in hard cash to withdraw. Okay? But the bank cannot print the bills, right? That's only the central bank does that. And the central bank balance sheet is 100 deposits from Bank A and 100 government bonds. Okay, I'll explain how the central bank issues money for the first time in the next slide. So they simply ask the central bank to print $10 in hard cash and send it to them, and it would be just like the central bank, just like the bank withdrawing 10 from its account with the central bank. So now instead of having 100 on deposit with the central bank, it has only 90 because 10 the bank has in its pocket. And after now the bank has this 10 in its pocket and only 90 with the central bank, it's ready to satisfy the withdrawal request by the client depositor. Okay, so now it can give 10 in the ATM to the client, and now the client, instead of having 100 on deposit with the bank, has only 90. Okay, so that's how hard cash, and vice versa. Now if they deposit, it would go here and back here. So that's how money works. Okay, this is actually the most kind of abstract part of the lecture. I don't know how many of you wake up every morning and ask yourself, well, if we start a new country and we need new currency, how are we going to circulate the money first time? I don't know how many of you have ever thought about this question. How does money get circulated first time? I don't know, I think about this sometimes. I thought about it one time and I wrote it on a slide, and now I'm forcing you to think about it. You can make money with this knowledge. Trust me, just be patient. You can make a lot of money with this knowledge. Trust me. Okay, so we start at time 0 with the government having 0 and 0 on its balance sheet, and the central bank having 0 and 0 on its balance sheet. Okay? And poof, now t equals 1. We start off this economy by the central bank what we call printing, but I'll explain very soon that you will see from this example that printing is the wrong term. He simply credits 100 to the account of the government. So this should be base money, or this is the account of the government. The government has an account with the central bank. Say there's no banks in this economy, just one central bank. And then the government has an account with this one central bank in the economy. And when they log in, they see 0. And all of a sudden, poof, they see 100. How can this be? Well, I told you, it's just an Excel spreadsheet on the central bank's database. And an employee came and changed the number from 0 to 100. It's absolutely possible, okay? This is not a natural, this is a very artificial system, man-made. And they just changed the number from 0 to 100. And they allow the government now to withdraw this money into hard cash and to pay it to whoever they want, either by electronic transfer or a cash payment. Okay? So this is a liability to the central bank. If I'm the government and I see now 100 that I can withdraw, this is my asset. So this is the central bank's liability. Okay? If poof, all of a sudden my liability went from 0 to 100, either my equity went as the central bank. Either the central bank's equity went to minus 100, or they have a commensurate asset. And they do. So the government doesn't get this money poof for free in its checking account, but it issues at the same time a bond to the central bank saying, I owe you 100 principal, let's say interest rate is 0, in the future. And this is a liability to the government and an asset to the central bank. This is how money gets distributed first time, and this is also exactly what they call quantitative easing. Okay? They come up with names to confuse the people that they don't know actually what the basic mechanics of the things are. Also, the word liquidity, by the way, is the most abused word in finance. The only liquids that I know in finance are cold drinks, warm drinks, beer, and distilled beverages. Okay, and why? I don't know, but people said the central bank is adding liquidity. Have they even ever shown such a simple thing to explain to themselves how this thing works? I don't think so. I mean, for a fact, I know that many of the greats don't know the very basic mechanics of what is money. Question?
Two questions. So here you make the example with 100, but they could have started also with 500, with 1,000, which would have been exactly the same.
Sure.
Okay, good. Second thing is, what is, historically, you always had the conversion with gold. Can you explain how gold works within this context at the beginning? Because I think, one of the rationale at the beginning is to make sure that what is issuing has some value, it was back up with gold.
Sure. So that's a good question, and I'll add it to the next lecture, so I have a very kind of concrete example. But just offhand, instead of a government bond, there would be an asset here of 100 gold. Okay, maybe the government took it from the people, so it's the government asset, and they gave it to the central bank. Now it's an asset of the central bank. There would be 100 value gold, and then there would be 100 maximum 100. This would be a limit on the amount of liabilities that they can issue. And this way, when a bank wants 10 out of its 100 as hard cash, cash means gold, then they would have 10. If they want the entire 100 back in gold, then they would have 100 in gold. So instead of a government bond, there would be hard gold here. And then this would also be a hard limit on the amount based on the conversion.
Makes sense.
And then at some point they would say, well, the conversion rate is not 1 for 1, it's 1 for 5. And then they would increase this from 100 to 500. There will be another 400 that they could give the government to finance war or whatever. that would be debasing the currency. Okay? I want you to understand that money is in zero net supply. Okay? I showed you that if you start at zero, you can move to, now the amount of base money in the economy is 100, it just as well can be 500, but it's 100. And now let's run it to t equals 2. Now let's say I'm the central bank, and I'm saying, well, let's say I have the power to decide over this country. I said, well, this was a really bad experiment. Let's you give back the loan, and we call it a day. Okay, we call it a 2-day because it's 2-day economy. We call it 2 days, and that's it. We go home, and you go, and I don't want to see you ever again. Give me back the money, and we're closing this country. And this can very well be. So how would our balance sheets look like after you pay back? You have it in my account, or you have it in hard cash, or maybe you paid it to some individual to build the roads and whatnot in the beginning of the year, and so you don't have it anymore, but he has it, and now you're the government, you can tax it away back from him, so you take it back from him in order to repay me. Because let's say you're really scared of being bankrupt. So you take it back, and then you simply pay it back to me. Now it's all anyways on my Excel spreadsheet. So I just cancel out my asset with my liability because you pay back the bond. I get the money back to myself. Now I cannot, it would be the same asset and liability on both sides, so you just cancel them. And then the balance sheet degenerates back to zero. So when they say the amount of money in the economy increased, it's just the amount of assets and liabilities, both in the economy exist, but the amount of equity stays the same. The net amount of money is always zero by definition. So if all debts in the economy were to be repaid with or without a haircut, doesn't matter, then all of our balance sheets would generate back to zero in that currency. What does this mean? I don't know. It's the most abstract point of the lecture, okay? But it's an important one to understand because people talk a lot about, oh, they're printing money, this is gonna cause inflation and blah, 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 blah. Let's not invest in our money, okay? There's always the excuses, oh, complicated theory, why not invest our money? I suppose there's someone here that always comes up with complicated theories, why not things can go badly, and why we shouldn't invest our money. But the point is that our money is always anyways invested, okay? Our money is always anyways invested. Let me skip this for a second. It's free financing to the central bank, okay? It's free financing to the central bank. When the central bank decided to give the government 100 in its checking account against a bond, now you can be sure that it's paying less as interest on the checking account to the government than it's charging the government on the bond. Okay? You don't need to be a genius as a central bank to be earning interest rate margin from even the simplest of balance sheets. Okay, like I showed you. They have liabilities, which is cash and electronic cash. Both of them are the same, identical, they're convertible to each other, I explained. Yet they're making between 40 and 80 billion every year, for even during the recession. This is the Federal Reserve profits. You don't need to be a genius to make money in the central bank, or as a banker, by the way. And so the fact is, even money in your pocket that you think is not a loan, it is a loan. It's a loan to the central bank. It's your asset. It's the central bank's liability. This liability is used as a source of financing to buy assets that give 1 or 2% interest rate. These are the government bonds and mortgage-backed securities that the Federal Reserve buys. The Swiss central bank is much more aggressive and diversified. They buy higher yielding stuff. They buy even stocks. and bonds. Up to 18% of their balance sheet is in stocks, and that's great. They're making good money. And just as kind of to understand the magnitudes, this is the federal expenditure in any year. So it's not really a meaningful amount. So most of the government's revenues are from direct taxes. So it's just another way. It's not a bad thing. It's not my intent to say that they shouldn't be making this money. I mean, if anything, this is a less intrusive way to collect taxes from the people than to make them file their taxes. Who in here knows anything about filing taxes? Some of you at least. And that's not pleasant. Okay, but if they just take it as they just make it on my library, it's easy. Yeah.
But this income did not exist when you had the gold standard.
Oh, it did exist then still. It must have still existed. Or maybe not. But they made money on it anyways. They did, because at any time that they devalued it, when they changed the conversion rate, that would be a windfall profit for them, and that they would give that to the government. They always made money. Okay, anyone, without even knowing the fact, I can tell you that if you're sitting on the pile of money of an economy, you're making money. You don't need to be a genius to it, because capital begets a rent. Okay, it's true everywhere. If you have a house, you can make rent. If you have a car, you can make rent. If you have money, you can make rent. It's a basic fact of social economics. But it's a good question. I'll try to look it up. What exactly was the mechanism that they made money with it? But it was a much harder constraint than they have now. It was a much harder constraint. Here are the quantities. You see it's about $4 trillion out there on the central bank's liability. And you see here about 1.7 trillion, 1.4 trillion in notes, most of it are $100 bills. I don't know how many of them are circling in Colombia. I don't know, I've seen on a documentary, but most of them are in Colombia. Another question, does printing lead to inflation or to currency depreciation? Not necessarily. People have been amazed at how the Federal Reserve and other central banks, here you can see it with it's a huge increase, even at the rate of growth since the financial crisis. It did the 1 to 5 almost, a factor of 5 in 10 years, 7 years. And similarly, the Swiss central bank, same thing. Where is it? Same thing. Since the crisis, and then massively. Where's the inflation? People, they're so geniuses about macroeconomics. They know everything about macroeconomics. You know what's the worst thing about being a macroeconomist? Is that everyone, even the taxi driver, thinks he's a macroeconomist. I'm not a macroeconomist. Please don't ever label me as a macroeconomist. Okay? I'm a financier. And, oh, where's the inflation? Well, I'm not going to give you a straight answer because there is no straight answer. That's the whole point of why economics is not a science. It's a social science. That's why social means it's like a negation in this. It's not a science. Social science means it's not a science because you can have so many theories and none of them are true or false. Well, every single one of them is false under some assumption, but none of them is true. You can never prove any theory to be true, and neither can I. But I can give you one example of how printing does not necessarily lead to inflation or currency depreciation. Because it depends what the central bank buys with its newly printed money. So like I said, quantitative easing is they simply credit the account of the seller of global stocks or whatever it is that they bought, with the value of these securities, and now they have the securities on their balance sheet as an asset. Maybe it's a very good asset, very high yielding asset, and it appreciates in value, it gives a very juicy dividend, a very juicy interest rate, and they're making more money than what they put in. So then when the money comes back, they have more wealth. Okay? So, particularly when they purchase foreign currency, they were sometimes surprised, why is the Swiss franc remaining so strong even that they're printing so much money? Because what were they doing with these printed Swiss francs? They were buying really quite profitable assets. Globally, very diversified and profitable assets. 18% with these Swiss francs went into US equities. These went up. And now if they were to repatriate these profits and sell them back to Swiss francs, this would be a huge force to appreciate the Swiss francs versus the dollar. So it can be that in anticipation of this, you print more Swiss francs today and you buy within dollars, but in anticipation of this being reversed in the future with a huge gain, then this wouldn't lead to depreciation. Okay, so there's several ways of doing this. It doesn't mean that this theory is correct, that theory is correct. Simply stating that, oh, the printing inflation, I don't want to invest any of my money. I'm like, please invest your money. Okay, it's good for you, it's good for us, it's good for everyone. But there's people like that. Okay? Any question? Sorry. Okay, so it's free financing to the central bank. I'll explain that. And it's also free financing for the banks. Now, the banks are making profits every year in aggregate an order of magnitude larger than what the central bank is making. Okay? So, the central bank, while clearly having the ultimate monopoly power of money, they are not even such profit seekers. Okay? Well, they don't get such bonuses. They're not allowed to. So what they have on their assets is a very kind of bland mix of assets that doesn't give them so much, maybe 1.5% on average. I show it, it's Gabby box. Because they have different kind of objectives. So the monopoly rent from this system of absolute monopoly, maximizing monopoly rents, and I'll talk a little bit about this in a sec, accrues to the banks more so than it accrues to the central bank. So I don't have here any similar to this to show you how much the banks are making, but it's an order of magnitude larger. Why are the banks getting free financing? Well, I've shown you that and you know, that if you want a bank account, you must keep it with the bank. It's what's called a bank account. You cannot have an account directly with the central bank, and you can't facilitate your economic life with cash. Then you need an electronic ledger entry, and that must be with a bank. And the reason it must be with a bank is because you asked me, what do I need to get an account with the central bank? Well, you have to have a banking license. This is by law. So we, the public, is forced to have an account with the bank. And we never even understood that we're forced by arbitrary decision to have our accounts with a bank. And more so than that, these banks are not simply taking our deposits and depositing them directly with the central bank and not making a profit on us. No. They are lending these monies out for a profit. Again, you don't need to be a genius. If the entire public must deposit money with you or with your friendly competitor across the road, and there's only like 2 huge ones and like I don't know, another 10 small ones, to make money. Okay, and these are, right? And yeah, question?
Nope.
And okay. So this is kind of So they would take maybe 90% deposits for clients, and this is a simplified example, 10 equity, and only 10 of the 90 they would keep with the central bank, and 90 would keep with loans. But actually it's more like this, where they would get 40, the vast majority of their liabilities. The very essence, the reason for their existence is the deposits from the public, which they pay next to nothing on. Built around this is their entire operation of issuing additional money via bonds and notes to the public, which is fair and square because you can choose whether to buy the bonds or not. But this one, you have no other choice. They would have other and derivatives, kind of 20 liability. They would have only 5 equity, or maybe 4. So banks, a typical bank would have 4% leverage ratio, which is by far the most leveraged entities allowed in the economy, other than the central bank. And they have huge balance sheets, which are concentrated in the hands of very few entities. Okay, and only 5 they keep with the central bank, and maybe 50 they lend out as loans, mostly mortgages, and 45 is other and derivatives. So it's a fact that the banks have monopolized the the old-time business of turning deposits into mortgages. So the deposit into mortgages trade is monopolized by the banks in each and every country. And let's talk about this monopoly power and how bad it really is. Now, you guys have an account, you're Swiss tax residents, or maybe even Swiss citizens, and you have a personal account with a Swiss bank. You never had any problems opening an account, right? Because you are the simple and risk-free client, and there's enough competition that you would get good enough service. But if you try to do any cross-border business on the name of a company, a foreign company, especially if it's an offshore entity, especially if it's an entity that is dealing in a competing industry to the banks, such as financial services, such as a hedge fund or a payment service provider, you are forced into the hands of your competitors. And you would be shocked to learn at the predatory behavior that they exhibit in denying people service, denying people accounts. Global, it's a global collusion. It's practically impossible to open an account for offshore. Try it, okay? So again, it's fine that the central bank makes systematic profits. It's actually a much less intrusive way than collect taxes, because the profits go to the government. But I say it's a great wrongdoing that you must have a banking license to be allowed to take deposits from the public and be allowed to deposit with the central bank, okay? And just again, going back to that structure, this structure, this reminds me more than anything the De Beers diamond monopoly. Okay, I don't know if any of you have diamonds. Show of hands, girls. Diamonds? No. Okay. Well, I have some. Or you can come see. And okay, the De Beers was the longest-standing, pure, near pure monopoly that ever existed. Okay, they controlled maybe 90% of global production that was naturally concentrated in 5 or 6 global mines. 5 or 6 mines all over the world were 90% of the output. All of them were owned by one family. Okay? This was the Oppenheimer family. They called themselves De Beers after some guy that was kind of started it, but in South Africa, but he's long gone. Okay? They've controlled it for decades. And think about their challenge. They're selling something that should go in every household in America, Europe, and Japan. But they're one family. Okay? How are they going to distribute without their evolving kind of an efficient secondary market that would bring the prices closer to production? How are they distribute to the entire world and having to rely on other distributors wholesalers and retailers, while maximizing their monopoly rents, maximizing the price for the diamonds. And the answer is, and this we even know from economics 101, that under very simple assumptions, the way to monopolize is to monopolize along each chain of the vertex, along each point of the you want to monopolize. So you start at the top, and then you branch out to only very few, and you give them local monopoly where they are operating, and that's exactly what they did. They came up with oddly the same word. It's called a site. Oddly the same word. Site system, where maybe 100 or 200 families that they were diamond dealers. They were the only ones that were allowed to get rough diamonds from the De Beers monopoly. So they would meet once per month or so in London, and they would get their batch, more or less what they need, and they were highly controlled. If you didn't like your batch this time, you better not show your discontent, because maybe next time you don't get it. It was very strict control over the site holders, and the site holders were very thankful, because if you had a site, this was a license to print money. Okay, they were making a lot of money, the site holders, because they had local monopolies. So wherever they were operating, in whatever country they were selling, they had the local monopoly that they got from De Beers. But the way to increase overall monopoly rents in such a monopolized industry, which starts at one source, or practically one source, is to monopolize it at each point on along the distribution. To give away the monopoly to the ones that you have to rely on to distribute. You don't just say, well, anyone can come buy from us at this price. No. You only very select few, and you give them so much monopoly power, because this way you get higher prices. Okay? And this is oddly like money is still today. The biggest, by far, and longest standing monopoly in the world. And nobody is questioning this. Questions? All right, going back to the predatory behaviors of banks. So a lot of people don't like banks, but they take it the wrong direction. Like whenever a bank gets caught by facilitating money laundering, and then the bank gets a huge fine. This, as a result, actually increases the monopoly power of the banks, and everyone else, like us, is suffering as a result. So you might want to take that in consideration, because I'm going to talk about anti-money laundering rules and how the banks are using the anti-money laundering rules, which they've adopted internally, to be much stricter than the anti-money laundering rules prescribed by law, in order to increase their negotiation power in front of clients. You want an account with us? Oh, let me ask compliance. What kind of business do you plan to do with us? Oh, just an account to send money in and out? Oh, we don't do that kind of business. Oh, you want to buy securities and pay fees? Oh, maybe. Let me ask compliance. Okay? Compliance is the #1 tool of monopolization for the banks. Don't ever, please, if you have some, before we kind of, engage each other in any kind of business transaction, if you need to clear this with anyone, do this. But don't tell me the C word. Don't say the C word, okay? Okay, any cross-border business will be denied an account unless you have a personal introduction to the bank, just like communism, and unless they're gonna make at least $5,000 a year from you, okay? If it's an offshore, cross-border, offshore companies. Non-bank financial institutions, okay? Payment service providers, hedge funds, okay? Anything that's financial, very hard to open an account. Globally, by the way. Complete boycott of anything blockchain or cryptocurrency. Practically impossible worldwide to open a bank account for a company that has anything to do with cryptocurrency. Okay? Impossible. Okay? So the point is that these AML rules have severely exacerbated banks' monopoly power. Okay? Banks are holding hostage even big companies, Novartis, Roche. Okay? Their clients are banks. They need to do what's called treasury transactions. They need to send money in and out. They're held hostage. Ever having to negotiate with the bank for lower fees on the transactions or less negative interest rates that the bank charges them. And the bank would always negotiate with them, well, what kind of M&A business you have for me? Then maybe I can give you better terms on the money transfers. On the simple transfers and deposit, maybe if you have M&A business for me, then I can get you a better deal. Let me talk with them and come back to you. They're ever negotiating, they're ever monopolizing their position at this. Okay? Another indication that this is a hugely monopolized industry is the insane compensation packages. Okay? Correct me when I'm wrong. I don't know how much you guys are making. I hope as much as bankers of equal rank, maybe somewhat lower, but it's the highest as it gets for a 9-to-5 job. Trust me, you don't have to be a genius to be a banker. Say yes or no, sir. CEO makes 10 million a year. Okay, CEO that I know personally takes Fridays off. All right, chairman makes 6 million, executive board 46 million, group managing director 2.5 million on average, total comp a year, managing director 1 million total comp a year on average. All right, you might say, well, I know managing directors, they cannot make 1 million, but that's the numbers. Okay, you can Google it. Try to research this online. Managing director makes on average 1 million total. Board member about 500K, executive director, which some of you can be executive directors, about 220. Very long tenures of the people at the top. They stay there 20, 30 years taking this money. Jamie Dimon, how long has he been chairman and CEO? He took at least 100 million from what should be public funds, okay, in total. You think he's a genius? You think he knows how to lend money? Nobody else knows how to lend money. All right. Surveillance and denial. Okay? Any deposit or withdrawal is subject to monitoring, questioning, and potential rejection by a bank, and banks do not hesitate to close accounts. So many people have been served with a letter. Oh, sorry, your account is less than 1 million. The compliance work that we have to do is not profitable enough. So please take your money elsewhere. Less than 1 million. You have clients that this happened to them? You heard the people that this happened to them? This happens. Okay? It's legitimate. I mean, they're a for-profit business. If it's not profitable for them to have you as a client, it's legitimate for them to say goodbye to you. But they have a monopoly and exclusivity. Where else are you going to go? You have to go to one of them. All right, no other option. That's, yeah.
So, I understand, so they try to reinforce their monopoly position, but when the bank, commercial bank, issues a bond, this is against their own interest because it weakens their position.
I don't know. I mean, they can.
Because they could get the site deposit for free.
I don't know if they can get it for free. I mean, they have so much side deposits. This is mostly kind of marketing and brand recognition that people just go to this bank. If it's UBS CKB, then it has kind of a. If they increase now the interest rate that they're paying on deposits, they don't really do that. But that's maybe one way to attract more depositors. But I think it's easier for them to issue a bond at 1% interest rate than it is now to start advertising. Because the bond investors are more sensitive to interest rate. So if bond investors they see 1% on a bank bond, which is senior, they would go for it, and they could get lots of liabilities, lots of financing this way. If they try to collect the same amount now from depositors, yes, they have a huge amount of depositors already, but this is already the situation. That's the existing kind of brand recognition. If they want to attract more depositors, by offering higher rates, and these are mostly retail investors, retail people, they don't care about 1%. You need to attract them with 3-4%. So it's easier to increase your balance sheet by issuing bond about a certain size. But yeah, if you have, I don't know how many decades to build your brand and attract people because they have to go somewhere, they come to you, then you have that as a source of financing for free. Anti-money laundering rules are perverse in the sense that they force the ones that are trying to compete with the banks, like payment service providers such as TransferWise. Are you guys familiar with TransferWise? Okay. It's a payment service provider. So it's, going back to here, it would be one of the clients of the bank would be an aggregator of further client deposits. So this would be TransferWise money with JP Morgan, but TransferWise, it's not their money, it's the client's money. TransferWise would be called a payment service provider. And people call it e-money, and this is very confusing, as if it's money, but it's not real money, it's fake money, or what is e-money? The point is that they are forced into the hands of the banks. And then what they say is, well, yeah, better technology, this is why we can offer cheaper prices. It's not really about technology. It's about the monopoly. It's about negotiation power. If they have enough size, then they can negotiate JP Morgan a bit lower. Okay? So there's nothing technological about this field, okay? But another point is that even these payment service providers, their anti-money laundering rules oblige them to accept money only from an account under my name. So let's say I have an account with TransferWise, either personal or corporate account, and I want to fund it because now I want to move it via using TransferWise and not using the bank. They say, well, we can only accept money into your account with us from a bank account under your name. But the whole reason why I'm coming to TransferWise is because no bank would let me open an account because they don't like me because it's cross-border. So the anti-money laundering rules are forcing the brokers, like securities brokers such as Interactive Brokers, and payment service providers such as TransferWise, forcing them to the hands of the banks. Not only do they have to have an account with the bank, also the clients have to have an account with the bank. That's negating the part of the reason why they even exist, to allow you an alternative to the banks. So sometimes, furthermore, it must be only a local bank. So sometimes it means, let's say I want to invest into invoice financing deals. It's a known business practice to invest into invoice financing deals. And there's one loan broker in Singapore that's doing all the due diligence and the servicing on my behalf, and I would invest my capital via this broker into these deals. The broker very much wants to take my money and do business with me, but he says that their anti-money laundering rules force them to accept money from me only if it's coming from a local Singapore bank account under my company's name. But there is not a single bank in Singapore, I asked all of them, that would take any foreign company and let it open an account unless they have major presence in Singapore, such as board directors and business activity and offices. But if I were to do that, then I would be subject to taxation in Singapore. So you can't win with them. It's monopolized along every point of the vertex, and the anti-money laundering, what they say anti-money laundering is always the killer tool, okay, that they use. And even if you open a local company, say a Singapore company, to do this business, and even let's say it's a partnership, you don't have to, but whatever. So you figure out the tax situation. Even if you open a local company, then the local banks wouldn't let you open an account because this local company, even as a Singapore company, doesn't have physical presence in Singapore. The directors sit abroad, and so on. So every little thing that is out of the ordinary. If you're a Swiss citizen, personal account, no problem. Once you deviate from that, corporate account, cross-border, offshore, financial industry, cryptocurrency, God forbid, I don't even say the word, because they might hear it and close my account. I have just one account. And then they say, no, sir, forget it. Unless it's with a personal introduction to the bank, like in communist era, and unless they're seeing at least 5K a year from you. Okay? So the point is that they've adopted AML rules which far exceed the actual law to their profit maximizing advantage. But on the other hand, bankers are making so much money that they don't even care to maximize profit in many cases, and they would simply deny even profitable accounts. Because you know what the hell, I'm making so much money by having this position in a monopoly bank, then why would I do anything out of the ordinary to risk my reputation and position? So even profitable business, and that's the definition of monopoly. It's both profit maximizing by using predatory behavior and inefficient, thus denying even profitable business. Any questions so far? You like where this is going? All right. Amassing of capital. Okay, banking is a very concentrated industry with the top 10 banks having 10 trillion plus in assets. Okay, it's huge. It's hugely concentrated. They're also by far the most leveraged institutions on the planet. About 4% leverage ratio, and this is after all the increase in capital requirements. It used to be about 2.5%. The main reason why over the decades they've grown so large is because of this one simple lesson that escapes every economics course that I've ever taken or heard of, which is this course exactly that I'm teaching you. That this structure of how money is by definition starts at the harmless monopoly, which is the central bank, and then kind of flows down to a for-profit oligopoly. And the reason they grew so big is because 40% of their liabilities, of their funding source, is trapped, cannot go anywhere else. Okay, like I said, you don't need to be a genius if you have a 400 billion deposits from clients, and then you issue another 400 billion of bonds and some other liabilities, and you bring maybe 50 billion from home, and you have a balance sheet on the asset side, $1 trillion francs. You don't need to be a genius to make money every year, especially if you include executive compensation, if you add back the executive compensation to the profit. Nobody ever thought of that. Like they say, you don't want to own the bank, you want to work for the bank. And you want to be inside to take a salary more so than you just want to buy the shares, because the shares never go up so much. Because it's managed such that the bonus, if it's a good year, the bonus are higher, such that the return is just okay, so they don't get fired. So the upside is capped by the bonuses. Coordinated actions. Okay? They have massive monopolistic power, as discussed, and this leads to high compensation packages, which leads to bank executives not wanting to take any reputational risk ever, which leads to all of them doing exactly what the others are doing, more so than other industries. Okay, other industries have corporate politics and people are calculated in a certain way, but in banks it seems that it's even worse, because this industry is much more monopolized. That's why they're even more strategic in the corporate kind of decisions. And they always never deviate from what the others are doing. In fact, well, the others are doing it too, is the number one excuse that I heard when I was in the bank. And I thought, you know, when I was in kindergarten, they said, well, the others are doing it, is not the right, is not an allowed excuse. They taught us this in kindergarten. But in banks, it seems still an excuse. Okay? Systemic risk. The reason the global economy is so sensitive to coordinated losses, you know, losses that occur at the same time in the banking industry, is exactly because of the above. Huge balance sheets, maximally leveraged, concentrated in relatively few banks, all of which buy the same assets. Okay, so that's why the economy is so sensitive to systemic risk. Tens, if not hundreds of thousands of economists, academics, students, regulators, central bankers, bankers, and journalists have obsessed about how to make the world safer from systemic risk and how to make the banks too big to fail. How many people were employed just to make these kind of research packages to sell to the banks so they would be thought leaders on this field of systemic risk? So many people employed in this. The solution is simple, and it already exists. I'm going to give you the solution. I hope you trust me that this is the solution. You can judge for yourself, and it is. Okay? The sources of the problem, again, the combination of exclusivity in deposit making with the central bank and exclusivity in deposit taking from the central bank. From the public. This should be from the public. Deposit taking from the public and deposit making with the central bank. They have exclusivity. Only banks can take a deposit from an individual, and only them can deposit with the central bank. You know, only them can give you an IBAN. Right? Where's my IBAN? Just give me an IBAN. Free IBANs. You Google it. You need it. It's hard to get. Solution. The Central Bank Depository Institution, the CBDI. Okay? I call it the CBDI. It's the term I'm coining right here and now. Okay? CBDI. The Central Bank Depository Institution. It's deliberately not called the bank. The banks are also a depository institution, but I'm not talking about that. I'm talking about the CBDI. I'll explain in a second what is CBDI. I've already shown you. Why impose such extreme regulatory requirements to allow opening a depository account in the central bank? You asked me this. You asked me this. Why do you have to have so much capital, and then you have to have, you know, processes in place, so many for anti-money laundering, for making sure you have enough liquidity, for all these things? Why is it so complicated? And another very related question that actually answers this: why impose on the public to have a deposit with a non-risk-free bank and allow the bank to utilize that cash for lending? Why you put these two things together? You make it so difficult for the banks to become banks, and then when they do, you let them lend out the money of the depositors. So the things go together. It's very hard because they want to make sure that you're not going to lose the money of the depositors. But why even give them that right to begin with? And why make it so hard? Why don't you make it easier for what I call a degenerate bank, exactly like I showed you here, that this bank is only allowed, is allowed only to take deposits from it's allowed to take deposits from the public, give them their own IBAN, but the only thing this CBDI is allowed to do with this money is deposit it with the central bank. It's not allowed to lend it out, and therefore it's credit risk-free, because the central bank is credit risk-free. The reason why the central bank is credit risk-free is not so simple. It's very neatly explained by a speech by Thomas Jordan. Here, you can click this link. I'll find a way to share this slide with you. But the central bank, and this is why also the central bank has almost zero equity, because if it goes into negative, then nothing happens. The central bank cannot go bankrupt. Okay, it's by definition, and therefore, such a degenerate bank, a CBDI, that all it's allowed to do is, with the money that it gathers from the depositors is simply deposited with the central bank, it's credit risk free. And therefore it doesn't need it doesn't need capital requirements, maybe just a little bit against operational risk if they make things wrong. And they don't need liquidity requirements because they're anyways 100% covered with central bank deposits. Okay? Question so far? Question right now? And this is not even my invention. This exists. All right? So you don't even need to trust me. This exists and it works perfectly. I'm using one. I'll tell you in a second. All right? The CBDI is credit risk free. The above is because the central bank cannot have a default, which is nicely explained in this link. There's no need for a deposit insurance scheme. Okay? There's no need to include the CBDIs in deposit insurance scheme. I'm not talking about just one. I'm talking about the new kind of class, a new license. You don't need a full banking license to be allowed to take deposits from the public and make deposits with the central bank. You can either get a full banking license or you can get the CBDI license. And then it's a much easier license to get. You get in 3 months. You don't need so many capital, maybe just 100,000 in eigencapital. Okay? You just need to prove that you have the technology to be able to match liabilities with assets. And all you have on your asset side is the deposit with the central bank. And all you have on your liability side is the money that you took from clients and gave them their own IBAN. So you don't need to include this in deposit insurance scheme because I can never default from the CBDI because all my money is with the central bank. The central bank can never default. So I can always meet my client's demands. So I'm credit risk free. So I don't need to participate in the deposit insurance scheme. And now, if enough time passes and awareness to this additional depository option and enough money migrating from non-risk-free banks to risk-free CBDIs, especially retail, which you want to protect, then it would be safe to assume that those who wish to deposit with one of the risk-free CBDIs have already done so, or deposit with the non-risk-free banks are doing so out of their own choice, and then it would be possible to close the deposit insurance scheme completely and cancel the liquidity requirement of banks and cancel the capital requirement of banks. Let them be risky lenders that can default because you don't have depositors to protect because all the depositors that wanted truly to be risk-free could deposit basically directly with the central bank. Competition, competition, competition. CBDIs are cheap to set up, okay? Nowadays, with technology nowadays, you just need the online and the accounting machine to give people IBANs to connect to the FedWire or the central bank payment system, and you're set. I mean, you can set it up very cheaply, and you can get the license. This exists in Lithuania, of all places. Love that place, Lithuania. Member EU, Euro, national currency. Okay, they have they call it e-money license institution. Okay, you have the e-money license elsewhere, and that allows you to give people sometimes their own accounts, but you're forced still to open an account with one of the banks, so you're still held hostage. But only Lithuania, the e-money license institutions are allowed to deposit directly with the Central Bank of Lithuania, which is a member of the Eurosystem central banks. Okay? You can Google Paysera. Paysera is one of the biggest ones. Yeah, you get your own IBAN under your personal name, even if you're cross-border, you're not Lithuanian. Under your domestic company name, if you have a Lithuanian company, easily you get your own IBAN. Under your foreign company name, even if you're not doing business in Lithuania, even under your offshore company that's doing financial transactions and is dealing with cryptocurrency, with some of them, you can get your own IBAN. Can you believe it? That compliance is not really such a big deal. Okay? The cost to do payments is next to nothing. Most importantly, it's reasonably possible to open accounts, even if it's cross-border offshore financial services related. And surprise, surprise, making sure that my company or other people's companies that are allowed to open accounts with this e-money licensed institution and get their own IBANs, making sure that they're making AML compliant transfers is not such a big deal for these e-money licensed institutions. And let me tell you, they do a million times a better job than the banks. If you get an account with a bank, after you get the account, you can send money even to Mickey Mouse. They never ask any question. But the e-money licensed institution, because they're still a new thing and they're scared, then every third-party deposit or withdrawal that you make raises a flag, and then you're approached by compliance, and what you need to do is show one of the two, either an invoice that you're paying or receiving this money to substantiate this third-party deposit or withdrawal, or a statement. If you're sending money to a broker that you have an account with, then you just need to prove that you sent money to an account not under your company's name, but that you have an account with this broker. So either a statement or an invoice would suffice. Okay, that's the only thing that they can do, really, and it's possible. And going back to the benefits, competition, competition, competition. Competition in compliance first and foremost, okay, so they wouldn't be able to monopolize so badly with the C word. Competition in account opening processes. Again, compliance is the problem and the tool for monopolization. And competition in user experience, what they call technology, okay? It's not such a big deal to give you your own login and an IBAN. There's not so many things you can do with a bank account. It's just two transactions, credit and debit. Okay? And it already works. Any questions? And second layer of benefits. Okay, so this is a beautiful thing. It bypasses the banks. So instead of, if you're a payment service provider, instead of having to always deal with JP Morgan breathing down your neck and making sure that you can't offer too cheap transfers and deposits to your clients, or that you're not allowed to do this or not allowed to do that, you simply are allowed in here right next to everyone else. And then you just have to deal with the law, not with internal compliance that's used to monopolize against you. You just have to deal with the law that the central bank is bound by. Okay, so think of so let's go to the Folgeld initiative, right? This reminds a little bit about the Folgeld initiative, right? You guys have been following this Folgeld initiative in Switzerland? So the initiative was to force the banks to deposit one-for-one with the central bank as they have deposits from the clients. So all our money that's deposited with the banks, this initiative was going to force the existing banks to deposit this money with the central bank. Now this may sound great, because then the banks are kind of not so, they can always pay the depositors, and then the depositors are kind of safe. But it's really foolish, because since all the banks will be subject to the same constraint, and since the clients are offered no other option than to go to one of the banks, then the reduced profitability of the clients, because now the bank cannot lend for profit this money, but can only simply deposit it with the central bank, so the reduced profitability of these deposits would be rolled over entirely onto the clients. Okay, it's going to be a pure rolling over of this. And furthermore, this would increase even more the monopolistic power of the banks, because they will have now yet another excuse why they cannot allow accounts to unprofitable clients, or to profitable, or to clients in competing industries, or to just clients that are just slightly out of the ordinary. Because, well, after this law passed, we cannot even do anything with your money other than deposit with the central bank. Oh, don't even get me started on it with compliance. Forget it. Okay, it'll be another thing for them to monopolize against the public. So this was really stupid. All right. So I perceive them as stubborn fools. Think of the environmentalists. You know, the people that care so much about global warming. They put global warming at the top priority for decades, and neglected completely, made little progress on the more concrete topic of air pollution in urban areas that's hurting everyone's health with predictable certainty, giving cancer with predictable certainty. But global warming maybe doesn't even exist, or even if it exists, shouldn't be the top priority. And have alienated as a result of their silly focus on such, unrealistic and incorrect goal, alienated large parts of the public from the environmental cause generally. And just like the inventors, the people behind Fogel Initiative pushed back the topic of free money for the public in Switzerland by at least a decade, in my opinion. Okay, there's some additional benefits to this, like you can think that like second layer service providers can use the CBDI to facilitate loan brokering or swap agreements or escrow services. So think of collateral management between institutions. Like, let's say I were to enter a forward sale of some FX with a FX trader such as Currencies Direct, and they would usually ask for 5% equity collateral for me to deposit with them in case this goes against me. So maybe if there was enough competition from CBDIs, then I wouldn't have to deposit the money with their account. I could keep it in my account and just instruct my CBDI to freeze 5% and only to release it only to Currency Direct only at the end of the maturity of this contract. And then I could show this confirmation for this irrevocable order that I gave my CBDI to Currency Direct, and then they would let me put on the trade without having the money in their account. It would be sufficient for them that I put the order to freeze the money in my account. Think about it. This could also be done with current bank accounts, but there's really not nearly enough competition between the banks to compel them to open up their IT systems for second layer service providers. Okay? The opportunities for counterparty risk-free, or at least significantly reduced, are endless. So you have to understand, if I'm sending the 5% collateral to Currencies Direct, then for them, they're the bigger, I'm just the client. They're the FX trader. They wouldn't put it on unless I sent them the equity collateral. But if now they go default, then I might lose this equity collateral. So they don't trust me, and they force me to trust them. But if I was allowed to just keep it in my account, and they go default, then I get to keep my collateral. So it would lead to, there's enough competition in basic payment services, there would be a host of counterparty risk-free trading. Okay, this would increase the amount of counterparty, decrease the amount of collateral that's locked up in. Whether this is good or would lead to inflation or whatever, doesn't matter, but it would make things more efficient. So such API connectivity is also possible via the banks, but competition is insufficient to compel them to open up. How are we doing on times, by the way?
It's about quarter of an hour left.
All right. Okay, so another thing, well, we can skip this, but again, another important thing is banks will have to maybe increase somewhat the interest rates that they pay to depositors. Because if now I have really a risk-free option with a CBDI, and, well, I don't think the banks are so risky. Maybe both of them are kind of risk-free, but this one is truly risk-free. But the point is that this one allowed me an account. This one is completely monopolized. So if enough people move to the better service, and this guy offers me kind of reasonable compliance services, it's kind of a service that you get in jail. You know, it's not such a nice service, And also, when you go to jail, you can think of the prisoner as a client. And the jail providing jail service, but it's just like compliance services. but I'm getting more reasonable compliance services from the CBDI because that's their business. And it's not that complicated. Then if enough people move, then the banks, like you say, might have to pay a little bit more an interest rate to depositors to attract capital, because all of a sudden you're issuing a bond, another bond becomes expensive. So they're losing their depositors to the CBDIs, and they need a little bit higher interest rate. And maybe as a result, the kind of a second tier effect, the interest rates on mortgages would go slightly higher, maybe. Because, the mortgages are financed with deposits. Hopefully an exodus of capital would leave the banks. This would lead to more competition in attracting depositors and in generating assets, okay? If so much financing sources go to these kind of risk-free, bland, kind of degenerate, simple CBDIs, then people start thinking, well, where do I put the money? Obviously, I'm not making anything here, but that's fair. But I can move it to maybe an account of a loan broker. And this loan broker would lend the money. But this is not the bank, because the bank, I'm not seeing anything from the bank. But maybe I would go with like a local loan broker that gives loans to the people against cars, or personal loans, unsecured, or against real estate and development, or to finance invoice financing, or all the stuff that I invest in as a hedge fund manager via these local loan brokers. It seems reasonable to me that the demand for originating such assets, you have to remember, lending is a local business, not an international business. Lending is a very local business. The demand for these services would increase as more people move out from the banks, and then there would be more of this kind of mini cosmos of local lenders attracting the deposits from the public and lending them to people that need loans. So there's a huge I haven't even discussed the monopoly that banks have in loan giving. Okay, they do not give loans. This is a huge monopoly. So I was just talking on the side of the deposits, but the side of the assets of the banks, they are not really providing the services that the people need, like the types of loans, small loans to individuals. Most banks don't even do that, okay, because they're making anyways much more money if they lend 100 million to some big company, because then bonus is big. But if I'm lending a lot of small, then you need like low-rank individuals to work for the bank, and they don't make big bonuses. But if I lend 100 million in the investment bank, I make a big bonus, okay? So there's a monopoly in the asset generation, and then we need to add this to the lecture. Okay, now any question before the last slide?
Yes, I have one.
Yeah.
So what you explained is that you want to have a system parallel to banks,
Yeah.
to make available to anyone
Yeah.
the possibility to deposit money.
Exactly.
Okay,
So it would be an additional license.
It's possible right now if
It
you
is
have
possible.
just paper money. You convert your bank account into paper money and you put in a safe. And you have a direct.
Yeah, but you don't have your own IBAN.
Yeah, but you can still spend your money.
Yeah, but for my purposes to conducting business, I need my own IBAN. I need it electronically. Just money in my cash is not sufficient for my purposes. It doesn't answer my needs. I cannot invest offshore with Swiss francs here. I need an account to convert it to foreign currency, and only with the foreign currency I can invest, and I need a bank account to withdraw it. Cash is just not feasible at all. I'm not talking about replacing anything. I'm not talking about doing anything to the banks. On the contrary, I said that after a while, once whoever has moved to this risk-free option has moved, and whoever stayed with the banks has done so on his free will, then you can remove all these constraints and regulations on the banks. Let them be as risky as they want, and don't save them.
Okay.
I'm just saying it's literally an additional license. It's already in existence in many countries, and it's working flawlessly in Lithuania. It's an additional license. There's a banking license that you can give people accounts, and also lend the money that they give you. And there's another smaller account, is a baby license for a CBDI license that allows you to give people IBANs and let you open an account with the central bank, and limits you in what you can do with the money that you've gathered from deposits. Because you cannot lend it out for a profit. You can only deposit with the central bank.
Post-finance, do you know the story
Yeah.
of post-finance?
No.
Because they were only allowed to take money from public in the past, with my simplified word, and they were not allowed to grant mortgages. Meaning it's when it goes into this direction.
Sure.
But right now they've changed the model, or tried to change the model since